Welcome back to the FDS podcast. You know, we're all about giving you the tools to boost your business smarts, especially for those of you mid-career and looking to level up.
Absolutely.
And that's why today we're diving deep into a topic that's absolutely fundamental, the balance sheet.
It's something that can really make a difference in how you understand and navigate the business world.
Right. So let's start with the big picture.
Okay.
What exactly is a balance sheet, and why should our listeners, busy professionals, really care about it?
Well, think of a balance sheet like a snapshot, frozen in time.
Okay.
It captures a company's financial position at that specific moment. It shows what the company owns, what it owes, and what's left over for the owners.
So kind of like a financial health checkup for a business.
Exactly. It gives you a clear picture of its financial well-being.
Got it. So you mentioned this idea of what a company owns, what it owes. That makes me think of that fundamental accounting equation. Assets equals liabilities plus equity.
You got it. That equation is the backbone of the balance sheet.
Okay, so let's unpack that a bit. First up, assets. What exactly falls under that category?
Assets are anything of value that a company owns.
Yeah.
Think tangible things like cash, the inventory sitting in a warehouse, equipment, or even real estate.
Right, the stuff you can see and touch.
Exactly. But assets also include things that are a bit less tangible, like accounts receivable.
Accounts receivable.
That's the money customers owe for goods or services that have already been delivered or provided.
So it's like future money that's basically in the pipeline.
You got it. It's an asset because the company has a right to collect that money.
Makes sense.
Right.
All right, so we've got what a company owns. Now let's flip the coin. What about those liabilities?
Liabilities represent everything a company owes to others.
Okay.
This can be loans, outstanding bills to suppliers, those are accounts payable, or even unpaid salaries.
So it's like the company's outstanding tab, all the bills it needs to pay.
Exactly. It's any obligation that needs to be settled.
All right. So assets are what you have, liabilities are what you owe, and that brings us to the last piece of the puzzle, equity.
Right. Equity represents the owner's stake in the business.
Yeah.
It's what's left over after all the liabilities have been paid off from the company's assets. Think of it like the company's net worth.
So if a company sold everything it owned, paid all its debts, whatever remained would be the equity the owners share.
Exactly. And grasping this link between assets, liabilities, and equity is key to unlocking the insights that a balance sheet offers.
So it's not just about listing these items. It's about what this information tells us about a company's financial health.
Absolutely. The balance sheet is a goldmine of information for anyone who knows how to read it.
So what kind of insights can someone get by really digging into a balance sheet?
Well, one of the most straightforward things you can see is the company's net worth. We just talked about that.
Right.
It gives you a sense of the overall value of the business.
So is it better to look at a company's net worth on the balance sheet than, say, just their revenue or profit?
It's a more complete picture. It's not just about how much money is coming in, but also about the underlying structure of the business. The balance sheet can also give you a glimpse into a company's liquidity and cash flow.
Now, I hear those terms thrown around a lot.
Yeah.
Liquidity, cash flow. Can you break those down for us in the context of the balance sheet?
Sure. Liquidity is all about a company's ability to pay its short-term bills. Can they cover their expenses as they come up?
Okay, so that's liquidity.
Cash flow, on the other hand, looks at the movement of cash both into and out of the business.
Ah, I see. So a company might have a great profit margin on paper, but struggle with cash flow if customers are slow to pay their invoices.
Exactly. And the balance sheet can help you spot those potential problems.
How so?
By looking at the balance between current assets, things that can be quickly turned into cash within a year,
Okay.
and current liabilities, debts that need to be paid within that same time frame.
So a healthy balance sheet would show that a company has enough quick cash to handle its immediate obligations.
Right. Another crucial insight you can glean from a balance sheet is how well a company is managing its debt.
Debt management. That sounds important.
It is. By looking at the proportion of liabilities to assets, you can figure out how much the company relies on borrowed money to operate.
I imagine that's a big red flag for investors or lenders.
You bet. A company swimming in debt might be seen as a risky bet, especially when the economy is uncertain.
So it's about striking that balance, using debt strategically for growth without becoming too dependent on it.
Exactly. And that's why understanding balance sheets is so crucial. It helps you make smart financial decisions.
It's starting to click for me. I feel like there are a lot of misconceptions floating around about what a balance sheet actually reveals.
Oh, definitely. One of the biggest ones is that it's just a reflection of how much cash a company has on hand, like a bank statement,
Ah, so people confuse it with a simple cash count.
all the time. But as we've been discussing, it paints a much broader picture of a company's assets and liabilities.
So it's about the overall financial picture, not just cash in the bank.
Right. Another misconception is that killer sales automatically equal a strong balance sheet.
Okay.
A company can be bringing in tons of revenue, but if they're not managing their spending or collecting payments efficiently,
Their balance sheet could tell a different story.
exactly, it might reveal some serious underlying weaknesses.
So even a company that seems profitable could be in trouble if they're not careful with their finances.
You got it. And one more myth I often hear is that balance sheets are only relevant for big corporations.
Okay.
But the truth is, businesses of all sizes, even small startups, benefit from understanding and analyzing their balance sheets.
I imagine it's even more critical for smaller businesses or startups with tighter budgets and less room for error.
Absolutely. The balance sheet is a powerful tool for any business, no matter the size, to keep track of their financial health and make strategic decisions.
All right, so we've got a solid grasp on the fundamentals of balance sheets. Now, let's see how this all plays out in the real world. I know the FBS notes include a case study about a sawmill owner named Ryan.
Yes, Ryan's story is a fantastic example of how understanding and using a balance sheet can lead to building a successful business.
Okay. Tell us a bit about Ryan and his journey.
Well, Ryan's a 45-year-old entrepreneur. He owns Touchwood Millworks, a custom sawmill he's been growing for the past 15 years. Started small and steadily built it up
Impressive. How did he do that?
by being smart with his money, reinvesting profits, managing debt carefully, and making sound financial decisions.
Sounds like he's got a solid foundation for his business. So what can we learn from taking a look at Ryan's balance sheet?
Well, if we look at his balance sheet, it gives us a snapshot of his business's financial health.
Okay.
Starting with the asset side, Ryan has $10,000 in cash,
All right.
$20,000 in accounts receivable, and $50,000 worth of inventory. That's lumber and raw materials ready to be turned into those custom pieces. All of those are considered current assets.
Right. So these are assets you can easily access to cover expenses or, reinvest back into the business.
Exactly. Then we move on to the long-term assets.
Yeah.
He's got $250,000 worth of equipment.
Equipment.
Think band mills, kilns, planers, all the heavy machinery. And he owns the 5-acre property where his mill is located. That's valued at $300,000.
Wow. So his total assets come to $630,000.
You got it.
That's pretty impressive for a business he built from scratch. But of course, we also need to look at the other side of the equation, right?
Absolutely. We can't forget about those liabilities.
Right, the gets.
Exactly. So Ryan has $15,000 in accounts payable, those outstanding bills to his suppliers.
Okay.
He also has a $50,000 line of credit, something he uses to, manage cash flow when things fluctuate. Both of those are considered current liabilities.
All right. And does he have any long-term debt?
He does. There's a $300,000 mortgage on his property.
Right.
That falls under long-term liabilities. So adding up all his liabilities, we get a total of $365,000.
All right, so let's do the math. Assets of $630,000, liabilities of $365,000. If we subtract liabilities from assets, that gives us
$265,000 in owner's equity.
$265,000. That represents Ryan's stake in the business, his net worth at this point in time. So what can we tell about Ryan's overall financial health just by looking at these numbers?
Well, it's clear from his balance sheet that he's built a really solid business.
Okay.
He's got a good balance between what he owns and what he owes, and his equity position is strong.
Earlier, you mentioned that seeing how things change over time is a really important part of analyzing a balance sheet.
Oh, absolutely.
Do we have any information about how Ryan's balance sheet has evolved over the past year?
We do. And it's really interesting to see how those smart decisions have impacted his financials. For example, his current assets have grown.
Okay.
His cash on hand has actually doubled. His accounts receivable have increased, and his inventory has grown too. That suggests he's got strong sales and his operations are running efficiently.
So it's not like he's just sitting on these assets.
Yeah.
He's actively putting them to work to generate revenue and then reinvesting back into the business.
Exactly. And his long-term assets have seen an increase in value as well. The equipment value has gone up, probably because he's invested in newer, more efficient machinery. That's a great sign for long-term productivity.
That's really smart. What about his liabilities? Have there been any changes there?
Yes, and they're positive. His accounts payable have actually decreased, which is a good thing.
Why is that a good thing?
It means he's paying his suppliers faster, and that can go a long way in building strong relationships and maybe even getting better deals down the line.
It definitely shows he's responsible and on top of things.
Right. And his mortgage balance has also gone down, showing that he's committed to paying down that long-term debt.
Smart.
All these trends reinforce the idea that he's got a good handle on his finances.
It sounds like Ryan is very proactive about building a strong financial position for his business.
He is.
What about his equity? Has that shifted significantly?
Well, with the growth in assets and the reduction in liabilities, his equity has naturally increased.
Okay.
It reflects the overall growth in the value of his business.
So all those strategic moves, reinvesting profits, managing his debt, investing in his equipment, it's all had a direct positive impact on his equity and the value of Touchwood Millworks.
Precisely. His balance sheet is like a report card with straight A's.
Nice.
It really demonstrates how to run a successful business for the long haul.
Ryan's story is a great example of how powerful the balance sheet can be, especially when you understand how to use it. Now, I know the FBS notes also mention a case study about Todd, a logging business owner who's getting ready to retire. How does his situation compare to Ryan's?
Well, Todd's in a different place, right? He's thinking about winding things down, getting ready for retirement. So his balance sheet is going to look a bit different, more about stability than that rapid growth Ryan's focused on.
So even though both businesses are doing well, their goals are at different stages, and that's reflected in their balance sheets.
Exactly. So let's take a look at Todd's. Just like Ryan's, it's hypothetical, but it paints a good picture.
Okay.
His current assets include $10,000 in cash,
Okay.
$25,000 in accounts receivable,
Right.
and $50,000 worth of inventory, which in his case would be the standing timber. The log's all ready to go.
So he's got a healthy amount of liquid assets, just like Ryan.
Sure.
Important for any business, but especially when you're thinking about exiting.
Right. Now, when we look at his long-term assets, Todd's got $275,000 worth of equipment.
Equipment.
Yeah, that's his harvester, forwarder, all that specialized machinery.
Yeah.
Adding those to the current assets, we get a total of $360,000.
Got it. So let's see what's on the liability side. What does Todd owe?
Well, he's got $15,000 in accounts payable, those outstanding bills to suppliers,
Right.
and a $60,000 equipment loan. Both of those fall under current liability.
Right. Debts he'll need to settle within the year.
Exactly. And in Todd's case, there are no long-term liabilities, so his total liabilities come to $75,000.
All right, so assets of $360,000, liabilities of $75,000. Looks like Todd's owner's equity is
$285,000.
$285,000.
You got it. He's clearly built a lot of value in his business over the 25 years he's been operating.
It's interesting, though, when you compare his numbers to Ryan's. Todd's been in business longer, but his total assets are actually lower.
That's a sharp observation, and it shows how important it is to look at the balance sheet in the context of the business.
Okay.
Ryan's still in that growth phase, pushing to expand, investing in new equipment.
Right.
But Todd, he's probably more focused on keeping things stable, making sure he can get the most value out of his business when he's ready to retire.
So his decisions are more about maintaining than expanding.
Exactly. And if we look at some of the trends on his balance sheet from the past year, it
Yeah.
seems to support that. His current assets, cash, receivables, inventory, they've all gone up.
So even though he's nearing retirement, his business is still generating solid revenue.
Right. And just like Ryan, his long-term assets have gone up too. That equipment value's increased, meaning he's likely keeping those machines in top shape, maybe even upgrading them to stay efficient.
Smart move,
Hmm.
especially in logging. Having reliable equipment is crucial.
Absolutely. And when we look at the liabilities, we see the same positive trends as with Ryan.
Okay.
Accounts payable are down, meaning good relationships with his suppliers.
Right.
And his equipment loan balance has also decreased.
So he's managing that debt effectively, another sign of a well-run business.
For sure. And as you might expect, with the increase in assets and decrease in liabilities, Todd's equity has gone up quite a bit as well.
So both Ryan and Todd, their balance sheets tell a story of savvy business decisions, a solid financial foundation, and a clear vision for what they want to achieve.
That's a great way to put it. Balance sheets, they're full of insights about a business's financial health. But it's just as important to understand the big picture, the business's context, and the owner's goals when you're looking at those numbers.
Absolutely. This has been a really eye-opening deep dive into the world of balance sheets.
It has.
For our listeners out there, especially those mid-career folks looking to make a bigger impact, understanding these financial statements is a game changer.
Totally agree. Whether you're running your own business or looking for opportunities within your company, being able to analyze a balance sheet is a huge asset.
For sure. We just scratched the surface today. There's so much more to learn about financial analysis.
There is.
But this is a fantastic starting point. I encourage our listeners to take what they've learned today, maybe pull up their own balance sheets, or look at some from companies they're interested in.
Great idea.
See what insights you can uncover. And remember, FBS is here to support you on your journey to financial literacy and professional growth.
We are.
Thanks for tuning in to the FBS podcast.
Hey, this is Steve Bick with the Forest Business School. Thanks for listening to the FBS podcast, and I hope you will subscribe. The truth is, these deep dives barely scratch the surface of some of the topics we cover in the Forest Business School programs, and the podcast is a way of reaching a wider audience. Check out my website at vtfbs.com for more information. Reach out if you want to talk about one of the FBS programs or have custom training or project needs that you'd like to discuss. Again, thanks for listening to the FBS podcast.